Welcome to S&P Capital IQ's quarterly loan market update. I'm Ruth McGavin, a member of the Leverage Commentary and Data team. I'm going to talk you through some of the trends at work in the European leveraged loan market during 2014, including an increase in M&A financing and some of the signs of heating in the market. Out of the 45 billion euros of leveraged loan issuance so far this year, M&A related deals contributed 25 billion euros. This total was boosted by some jumbo corporate M&A deals, most recently the cross-border financing for Jacobs Douwe Egberts. Among sponsor-backed buyouts, LCD tracked an increase in the number of asset sales by corporates and families, which has brought some welcome debut borrowers to the loan market. Institutional investors continue to show strong appetite for leveraged loans during the second quarter, and heavy repayments on existing loans spurred them on. In fact, repayments reached a record quarterly high of 16.6 billion euros based on the S&P European Leveraged Loan Index, as the chart shows. Adding to institutional demand, there was lively issuance of new generation CLOs, particularly during June, including some new managers entering the 2.0 market. Sources say the pipeline for further CLO issuance in the second half of the year looks healthy. Through much of the year so far, there's been relatively little complaint from buy-side firms about leverage multiples, and indeed first lien leverage is pretty much flat on last year at around 3.7 times EBITDA. But second lien tranches are appearing more frequently, and this helped drive total leverage a little higher to 4.9 times. Some arrangers argue that leverage is unlikely to spiral up and up because this would result in deals coming to market with low single B ratings from two agencies, such transactions being hard to shift in syndication. Instead, the market is showing its aggression in other ways, particularly in the use of covenant-light loans. 10 billion euros of covenant-light paper, a record, has been raised this year, meaning that roughly 1 in 3 euros sold to fund managers had no maintenance covenants. The ELI index now includes a 13% covenant-light portion, the highest in its history, although this is still a long way behind the US, where the trend started. However, from the point of view of yields, Europe looked less aggressive than it did earlier in the year, as this chart suggests. Behind the scenes, yields on domestic European deals were flat from the first quarter to the second. But in line with the weaker picture in the US market, cross-border yields widened in recent months, dragging the average out too. Looking ahead, the picture around M&A issuance remains hazy but hopeful, while arrangers say they're pitching on some aggressively structured deals that may test investors' appetite for riskier credits. Based on the mood in the market in late June, it's certainly possible that there might be some pushback if terms get too heated. This brings me to the end of my market review. I hope you found it useful. You can download the slides at slideshare.net. If you'd like to know more about the leveraged loan market, you can follow LCD on Twitter, Facebook and LinkedIn, or you can visit our free websites, leverageloan.com and highyieldbond.com. The links are all in the info section on our YouTube channel. Thanks for listening. I hope you'll join us again next time.